So hi, I'm Moses, this is Calvin, Melvin and Alan. We're from Group 31 and we'll be discussing on our insights and results over the four-year period of Delta Signal. So we'll be firstly discussing the overview of our company, followed by the strategic decisions made, then followed by the insights of the results of the company. We'll then conclude this presentation by providing recommendations on how our company will sustain competitive advantage for the future. So I'll be discussing the strategic direction of our company, Delta Signal. So our company has directed in the primary strategy and management in the following 8 periods of being a product innovator. So a product innovator, as seen here, can be defined as the development and market introduction of a new, redesigned and substantially improved good or service. So the overall core strategy of our company was aimed towards the luxury automotive car manufacturing industry, which focuses on a target segment that has a great emphasis on innovative, high quality and up-to-date products. So our company has highlighted 2 main focuses as a result of our core strategy, that being to target the niche luxury market and extensive potential production on the innovation in car manufacturing. So while we have specifically decided to focus on the luxury segment and R&D behind the products offered, means that the design and deliverance of the product can be more specific and specialized to car manufacturers. So therefore, it has been our goal to increase sales appealing to a particular market of the luxury segment rather than catering to all customer markets. So our company has assessed, analyzed and scrutinized the corporation with focus on corporate strategy, viability of the company in the long run, and overall competitive advantage in the automotive electrical supply industry.
As seen through the 8-year periods, we can see a substantial financial growth and sustainability. By applying the value chain model, we were able to correlate changes to suit the luxury segment of our target market. After the 4th period, reassessment of all initiatives was made to ensure we were on the right track to achieve a balanced scorecard. And as a result of this detailed review, a decision was made to stop investment to 3 initiatives that were not giving expected returns, and instead funds were reinvested into 5 new initiatives to improve return on investment and to achieve a sustainable financial position. The strategic decision was to reinvest $8 million of funds elsewhere to maximize the return on investment. The strategies that were replaced included no questions asked replacement policy, customer feedback data capture project, and IT training collaborative in research and development systems. We made a strategic choice to focus more on research and development so that it aligned with our core strategy. As a result, from period 5 onwards, $8 million of freed up funds were reinvested in below initiatives to more research and development and product innovation. The following strategies that we used included new technology customer trade show, employee training, multi-company team management, supplier pipeline for innovation program, technology licensing initiatives, and monitoring technological product trends. Change in the investment strategy has paid off as it has enabled Delta Signal Corporation to achieve targeted investments in research and development, to become an innovative company, achieving a share price of $142.69, and an overall financial position that guarantees a long-term viability. Though Delta Signal Corporation has achieved a healthy financial position at the end of the 8th period, further analysis was conducted to ensure that a balanced scorecard was achieved as per the strategic objectives outlined in the strategy roadmap. Although the results were mainly positive, further analysis was uncovered that work was required in the customer segment to achieve a desired goal of a balanced scorecard, mainly due to underinvestment in the customer segment. During post-analysis of our results, management was at a crossroads where a strategic decision had to be made. whether it was to continue with resource leveraging product innovation strategy or completely change the strategy and instead focus on market adaptation strategy.
As Kelvin mentioned earlier, one of the main goals for us was financial stability and sustainability of the company, because through the study we can see that that's one of the area of the concern. So through the balance scorecard, we actually, through our investments, have managed to achieve pretty healthy balance sheet, and we can actually, just touching on some of the numbers, we can see the sales increase from $480 million to just over 907 mil. Although cost of sales has increased from 384 million to 691, the most important part is the actual gross margin is reflecting the company's heading in the right direction and it is profitable. And we can see that gross margins actually increased from 96 mil to $216 million. If we were to put it in a perspective, what does that actually mean? We can actually compare the net income, because we can see that company from a period zero, we had just under $10 million of net income. It's actually reached just over $44 million. So definitely heading in the right direction. Moving down, so operating assets were just over $1 billion in period one, and there were 1.1, just under 1.1 billion in period 8. The important part is the equity, so debt actually has reduced over the time, keeping the equity, growing the equity. So original equity in period 0 was $672 million to 716 mil in period 8, which is kind of reflected in the statistical way, where the net debt to equity ratio was 50% initially, and then over the time, and we can actually see at the investment, earlier we mentioned how at investment 4 we changed the strategy, that's actually come down to 46.39%. What does that actually mean in performance metrics? So cost of sales initially was at 80%, and we can see that gradually reducing to the point that we managed to achieve 76.18% in the period 8. Important part is the gross margin, because that's, I guess, highlighting the profitability and how well are we doing as a company. So period 0, we were at 20%, and we actually achieved 23.82 by period 8. Another figure that I would like to call out is the operating income. So operating income has also increased from 5.25% initially to 8.61. And then equally touching on net income, going from 2%, just over 2%, to 4.88%. And return on equity, because whenever an investor's looking to invest in a company, that's probably one of the first figures they look at. We can see the return on equity was just under 3%, 2.95 initially. And that's actually grown steadily, in particular again after reinvestment, where we've jumped gradually to 12.81%. So at this figure, I think this company definitely has a healthy financial future and would be pretty attractive to every investor out there. What does that mean is also reflected in stock market share value. Started at $40, and again after reinvestment, we were sitting at about $65. It's actually increased a great deal to over $115, and as Kelvin mentioned earlier, it was actually at $142 at the price we sold it to investors. Equally, dividends. So dividends started paying after the period, after fourth period, and we actually have just over $41 million paid out worth in dividends. And again, another measure that a lot of investors look at, what's the dividends per share? So what is the return that they'll be getting? And we actually managed to achieve pretty healthy dividend of $4.13. So if we actually, so we just talked a lot about the numbers. If we look at the financials and what does that actually mean? It's a bit easier in a graphical way. So here we can actually see on return on equity, as we made initial investments, the return on equity is gone into a negative, and over the time, as investments started paying off, in particular after the fourth period, where we actually changed investments, we literally cut our losses of the investments that were not giving us returns that we expected, and we actually reinvested money to something that will give us better return. Keeping in mind the main objective initially was how do we turn the financials of this company to have a sustainable company going forward. So return on equity is actually showing us that. Equally, gradual increase in sales started plateauing here a bit for good reasons, because some of the money that we actually saved earlier was actually moved from a customer segment into more research and development and investments. And later on, Melvin will actually touch on some of the recommendations we have. And again, cumulative earnings per year. So if you're actually looking initially first 4 periods, we didn't really expect much of a return and earnings, but then you can tell that our investment starting paying off, and we see a steep curve. So as I mentioned earlier, from a customer perspective, we did, I guess, take some of the money from the customer investments and reinvested it elsewhere. So although initially when we invested, we didn't really expect any customers to go and recommend us because they didn't know what we were all about. And then after the period 5, after reinvestment, we can actually see actually steep increase in customers that would recommend us. Equally, initial investments in customer requesting our products, new company, they needed to see how we actually go, so it was a flat line. But then after the 5th period and reinvestment, we can see there's more and more customers requesting our products. Keeping in mind it's plateauing here a bit, again, will be covered by Melvin in our recommendations. R&D partnership with luxury customers, no change. Again, signs of underinvestment in a customer segment, which will be covered in recommendations later on. If we actually look at R&D insights, so, you know, what these graphs are pretty much telling us is that we have pretty good innovative products out there, and with innovative products and viable company, that leaves us with just few recommendations and, you know, what can we do about the customer to increase those sales.
Right. The recommendation for Delta Signal is to continue with resource leveraging product innovation strategy for the next 3 years. In the BSC, customers were not prioritized by Delta Signal. Therefore, Delta Signal have to implement a better ethical environment in the workplace in order to gain a competitive advantage in the automobile industry. A customer will desire to purchase from a company that treats its workers appropriately. At the same time, Delta Signal will attract the best talent from the job market, which will in return provide exceptional service for the customers of the company. It is a strategy which has a win-win cycle leading to positive growth and, most importantly, a compelling competitive advantage. Also, Delta Signal must have tight governance over their customer value proposition initiative. This is needed to enable customers to see the value that they are getting. As luxury customers are paying a premium price for innovative quality products that are better than the rest of the market. Therefore, Delta Signal will gain a competitive advantage if they invest deeper in customer relationships. The current world is already impersonal enough. With the benefit of customer relationships, Delta Signal will be able to build on goodwill and improve word of mouth in the long run. A recommendation on customer integration strategy allows Delta Signal to draw out areas and have a more focused and target customer segment. For example, if operating in Europe and USA, Delta Signal may only choose to operate in Europe to focus on the growth in one customer segment. Besides that, Delta Signal can implement niche market approach by only focusing on luxury car. This allows Delta Signal to pinpoint customers who are loyal to the brand.